Good morning, everyone. Thank you for joining us this morning. A couple of housekeeping things. Guests are welcome to ask questions throughout this webinar, but everything is being recorded for your convenience, and we'll share those slides with you later on this afternoon. My name is Melissa Johnson. I'm an Assurance and Financial Reporting Principal in the Southeast Michigan region. Additionally, I co-chair the firm's manufacturing and commercial industry groups. Raymond continues our drive to help our manufacturing clients navigate everything from HR solutions, funding, forgiveness, tax provisions, IT security, and continue in it. I can't speak this morning apparently. Continuity. This morning we were going to hand it over to Ron Nipping, Tom Szymanski, and Tony Licavoli to help walk us through some of these important areas as we navigate the pandemic. And with that, thank you very much for joining.
Hey, thank you, Melissa. My name is Ron Nipping. I want to, again, thank you for joining us this morning, and thank you very much for the trust you have put in Raymond as we journey with you through this interesting adventure. I'm going to give a high overview of the program and the forgiveness, and then Tom Szymanski is going to go into the details of how applying for forgiveness and some of the intricacies there. And Tony will follow us up with how it applies to the manufacturing industry as a whole. But before I get into the overview of the Paycheck Protection Plan, I want to take you back 2 months to when this adventure started. Things are going relatively well now. A lot of uncertainties and challenges are clearer, but 2 months ago, just some of the headlines that were in the newspapers. The first one's fairly lighthearted: free toilet paper with an oil change. But the rest are a bit scarier. It's a ghost town, downtown Ann Arbor, desolate. Stock market plunges again. Markets see worst rout in 5 years. I'm just living a nightmare. Ohio residents worry about going hungry as COVID layoffs surge, poll finds. Michigan won't bounce back from COVID-19 recession until 2022. Coronavirus in Florida, state deaths projected to hit 6,700 by August. That was a crazy time back then. Sometimes it feels like a lifetime ago, sometimes it feels like yesterday, but things were a bit nuts back then. And the concerns from talking to many of you on this call basically revolved around uncharted waters and economic uncertainty. And that uncertainty was huge. You had uncertainties about your supply chain. Will you be able to get materials? Will they even be in business? Uncertainties about when your business can reopen to customers. Uncertainties about whether customers will return when your business opens. When can your business open? Uncertainties about whether a new wave, a third wave, or a fourth wave of the virus will hit. Uncertainties about whether customers will be able to afford your products or services. Uncertainties if employees will return if they get let go and take unemployment. That extra $600 a week definitely adds to that uncertainty. And then the biggest one was liquidity. Where's the next dollar coming from? So when we look at the Paycheck Protection Program from a real high level, what we're really looking at is the idea behind the program. It's what the US government, what they wanted to do was get money into the pockets of American workers and do it quickly, because they wanted to keep the workers off of unemployment, or if they were on unemployment, to get them back in a relationship with the employer. And the key part there was maintaining that connection. So when the employer decided the business is ready to open up again, he can get a hold of the employees and they can come back on, because that would help small businesses stay alive. Now the how was, the how was to distribute the money to workers through their employers via the banking system and the SBA. And they would use loans that could be forgiven. In effect, they're grants if the companies use the money as the business wants, but loans sounds a lot better in a national program of this size. And the net was thrown to a wider audience, with targeting an increased eligibility for certain small businesses and organizations, because they wanted to increase the impact on the economy, as opposed to just taking the traditional definition of a small business. And the mechanics on what the government wanted to do was require the employers to spend the money over an 8-week period. That was designed to get money into the economy quickly to keep the economy moving. And then they wanted to make sure the employers spent the rest of the money as the way the government saw it best. And that was 75% of the loan should be used for payroll costs and no more than 25% for utilities, rent, and mortgage interest. And my favorite promise within the US government tactics was issue guidance on forgiveness to employers by April 26th to provide comfort to employers on what's going on. Now, why we're all here to talk about forgiveness is pretty straightforward in the act. The lender, the banker you used, will be responsible for determining forgiveness within 60 days of the employer, the borrower, filing the necessary documentation. And the employer is to apply for forgiveness. We're saying within 21 days of the end of the 8 weeks covered period, but that timeline will be determined by your bank. Now, when you talk about going through purgatory to get to forgiveness, when you've probably experienced this, advice changing each week, new information coming out each week, we just posted here the frequently asked questions postings on the SBA website. We're looking at least once a week, sometimes twice, 3, up to 4 times a week, new information was coming fast and furious. We're still under 50 FAQs, but that'll probably change shortly because the SBA has promised that detailed information on forgiveness will come out soon, but that's something up in the air. What did come out though, and is not on this, on April 15th, the SBA issues the loan forgiveness application and instruction for filling it out, which takes a good amount of the mystery out of forgiveness. We're figuring 85 to 90% of borrowers' questions are addressed through this, and we're just going to be waiting for the last 10 to 15%. And if we don't get detailed instructions on that, we'll be here to help you navigate that for the facts and circumstances of your own individual businesses. But basically, the first part of the forgiveness is actually administrative easier and friendlier to the employer than we originally thought. And Tom will go into the alternative payroll covered period, but that's going to be a big help to a lot of folks. Some of the other details that we'll talk about is the reiteration of the 75% of the PPP loan proceeds to be used on payroll. That can be helpful for some and not for others, but that's what it is at this point in time. The SBA finally defined what a full-time equivalent employee is, at least within the CARES Act. And then a definite statement on rent obligation includes leases on both real and personal property. And Tom will go into detail about that in particular. But what I'd like to point out to you is the application does not contain an express recertification of necessity. There's one Shake Shack and Ruth's Chris and the LA Lakers came out that they had PPP loans. There was a lot of dust up in the press and in politics, and a good amount of people got nervous on what does necessity mean in this application. Well, it came out recently that if you have a loan for yourself or combined with your affiliates of under $2 million, the SBA will assume that you applied in good faith. If you have a loan over $2 million, you will get further reviewed by the SBA, and they may ask for you to explain more fully why you felt there was a necessity for this loan. But if you remember back to when I started talking, we talked about the headlines and concerns. I think everybody on this call had those concerns, especially over those headlines. What we're guiding our clients to do is, in all cases, just document what you were thinking, what your experience was at that point in time, and why there was a necessity for the loan. Now, I'm going to pass this over to Tom, and he's going to lead you through the application and talk in detail about many of the key points. So, Tom, you can take it from here. Tom, you're on mute.
Hey, Tom, we actually can't hear you. If you can go ahead and unmute your mic. Perfect. It sounds like you're back on now. We'll go ahead and get you back to your slide, and you should be good to go.
All right, sorry about that. Hope everyone can hear me now.
You sound great.
All right, perfect. Thanks, Ron. We're going to run through the application that was released last Friday. Trying to see if I can make this a little larger. Okay, so I've highlighted some sections on here that just I really wanted to run through just to point out to everyone. So the first thing is that everyone's going to have to supply their loan forgiveness application to the lender that they got their loan for. And what's been defined at what you'll need to supply is two things here. There's going to be the PPP Loan Forgiveness form, which is 2 pages. The first is kind of informational, and the second is, you're going to acknowledge what you're submitting and everything's accurate. The second thing is a Schedule A, which breaks kind of the summary information on the calculation form down into some greater detail. So those 3 pages will be the formal application that you'll need to submit. They will also ask for some supporting documentation similar to the loan application, such as payroll registers, 941s, and those types of things. But that's what's going to need to be provided with the application. There is a couple worksheets for the employee payroll calculation, a table 1 and a worksheet table 1 and table 2. You'll need to maintain those, but you won't be required to submit with the application. So I just want to kind of run into these 2 pages and kind of look at the form itself, and then come back up to some of the descriptions and instructions. So this is the first page of the loan forgiveness application. I think it's pretty straightforward. The top part of this form is really just informational. You're just filling out this information about your loan. If you're using the coverage period or alternate coverage period, and then it's just a really high-level summary of your information for forgiveness. Your payroll costs, your business mortgage interest and rent, utilities, and then everyone's probably familiar that there's two primary forgiveness offset tests. One is a 25% reduction, excess of 25% reduction wage, and the other was a full-time equivalency test. So those 2 tests have an impact on your forgiveness. And then this towards the bottom, it kind of nets out your gross forgiveness against these tests. And the final test is this 75% requirement that has to be for forgiveness based upon payroll. It's a simple calculation. It's just taking line 1 and divided by 0.75. And what that effectively is doing is it's setting that 25% cap on forgiveness that the guidance has laid out, that you can't have any more than 25% forgiveness on the non-payroll cost. And so this just kind of gets you down to your net forgiveness amount, and that's the number that you'll be applying against your loan for forgiveness and submitting to your lender. I'm going to slide back up to the top because they start with the information or the instructions at the beginning. So just running through a couple sections I wanted to talk about. And the big thing that they did, I think, to try to simplify the payroll aspect is they added an alternative coverage period. So you might remember that the coverage period was defined as 56 days from the first day that you get your loan. That coverage period will not change for non-payroll costs. So that's still going to be the tracking days for the non-payroll costs, and also the payroll costs if you choose to keep it. But they also are offering an alternative payroll coverage period. And what this does is it allows you to start your payroll tracking the following start. Let's say if you're on a weekly payroll, and if you got your loan on a Wednesday, you could actually start your payroll tracking the following Monday. So on that, and this is only eligible to weekly or bi-weekly. And so if you're on a weekly payroll and you got your loan on Wednesday, you could choose to start your payroll tracking the following Monday so that you can get a nice clean break on your payroll system. So it's easy to track your information. Now, if you're on a bi-weekly, that might mean that if you got your loan on Wednesday, it might not be the following Monday. It could be the Monday after if you're in the middle of a 2-week payroll cycle. So this alternative payroll coverage period is going to be helpful administratively, and then also just from a, I think if you were an employer that had a fair amount of people on layoff, and then you decided, hey, I've got my PPP loan, I want to bring a bunch of people back. Well, the practical, thing was probably most people brought people back the following Monday. So this alternative payroll will probably line up and allow you to capture more cost by shifting that to the next payroll period right after your loan was received, because that's probably more in line with when you called maybe some of your employees back. So that is something that will be beneficial, for a lot of you. Just a couple other comments in here. They did make a note for the non-payroll costs that you are not required to report payments that you didn't want to include in forgiveness. So, for example, if you've got certain payments that are going to take you well beyond that 25%, you don't even necessarily need to report them. There's no requirement that it's an all-inclusive number that you're reporting for those non-payroll costs. One of the things that they point out is that if you get a EIDL SBA a disaster loan advance, they are making the statement. You're going to notice it's not on the form anywhere, but they are making the statement that that amount will be deducted, from your forgiveness. I'm not sure why they just didn't put a line item to get to a net forgiveness number, but they are just collecting that information and will deduct that EIDL advance, which was $1,000 per employee up to $10,000. So, and then they kind of, another thing I wanted to point out was some of the definitions, the payroll cost, they've used this, they're using this term payroll cost paid and payroll cost incurred. And again, here is one of those things of the advanced or the alternate payroll is that payroll costs are considered incurred on the day that the employee's pay was earned. And so they give an example here that payroll costs not paid during the last pay period of the or not paid within the coverage period can be eligible for forgiveness if they're paid on or before the next regular pay date. So again, it kind of lines up with more of an accrual interpretation that if you use the alternative payroll and you don't start your payroll tracking, so let's say the following Monday, they are going to allow you to capture that eighth week of payroll, even though it's technically going to be paid outside of that 56-day window. So they're basically saying that if you pay that before the next payroll due date, which everyone's on a regular schedule, shouldn't be a problem, that will be eligible for forgiveness. So again, I think that'll be beneficial, for companies that have brought people back. You're going to want that forward kind of looking 8-week payroll cycle versus starting from the day one. Let's see, one other comment. Okay, so that's the schedule. So this is the second page of the schedule. This is where you're, doing your, signing, your initialing, and making, all of your representations. One thing that they did point out, though, is that, this section in here highlighted is they have defined owner's compensation as the less of your 2019 8-week equivalent number or 15,385 in your coverage period. So that is something that is different because it is a, in this example, or in an example, as a business owner, if you were a W-2, you had a W-2 wage, and you were at a $50,000 salary that you were drawing in 2019, you cannot increase that to the 100,000 cap in 2020 and have that forgiven. It's going to take the lesser of that 8-week equivalent for your 2019 compensation. It's going to take the lower of that or the cap for 2020. So that is something that you'll have to do that test for every for your business owners. The next schedule is called the Schedule A. Again, I'm gonna jump down to the actual form. And this form is kind of similar to, when you were filling out your application and really building your payroll costs. I would say the only thing, that's a little bit different on the forgiveness versus the application process is they are wanting you to use this Table 1 and Table 2 for calculating your compensation. And Table 1 is going to be for any employee that earned less than $100,000 pro rata on every paycheck in 2019. Table 2 is for employees, anyone that earned more than $100,000 on any prorated basis. Now, this isn't the easiest administrative way that this could have been done, because it does mean that if you had employees that got bonuses or large commission payments, and if in that pay period it pushed them over a pro rata 100,000, then they really fall onto Table 2. So while that could be a bit of a task to go through all your employees, what it does is that Table 2 does not have to go through the 25% excess wage reduction. So that does eliminate those folks from that test. But so in an example, on a weekly payroll, if an employee got a bonus and it pushed them past the 1,923, which is 100,000 pro rata on a weekly level, they would be excluded from Table 1 and moved to Table 2. So that's how they're tracking compensation on the employee side during the coverage period, is by splitting your employee groups into those two tables. And so it's going to calculate their compensation. Again, that is defined as capped as the 15,385 over the 8 weeks. So you don't have to worry about individual weekly or biweekly payroll amounts on a prorated basis. It's just simply that 15,385 cap for the 8-week coverage period. So you're going to track those wages and on these two schedules, and then it's going to feed into this summary schedule. And then again, it's going to run through the full-time equivalent testing on here, and then you'll also see a line 9 for owner's compensation. So you will have to break out owner's compensation individually. So you've got those 3 sections of payroll dollars, and then at the bottom of this form, there's the safe harbor, the full-time equivalent test, and they did add a safe harbor option for that. So, all right, I'm going to run through the instructions for the Schedule A. Just a couple things I wanted to walk through on this. Again, I mentioned the owner's compensation is capped at the lesser of the 2019 8-week equivalent, or the 2020 capped at 15,385, whichever is less. I think the primary other area that I wanted to walk through was the full-time equivalent definition and test. Let me get to that. And that's covered really on the schedule, the Table A and Table 1 and 2. So this is the last two kind of templates that they released. It's considered this Table 1 and Table 2. It's pretty straightforward. Employee name, identification number. Again, cash compensation, which is going to be under that 15,385. Average full-time equivalent, they're going to want you to calculate that by employee during the coverage period. Table A, there will be the 25% excess wage reduction. Table 2, it's pretty much the same, except this group does not have the wage reduction test that you have to run them through. So these are the two tables, and I want to run through the two tests, which they've added some clarity to for us. The first is the 25%. Well, first let's start with the FTE definition. So that was the big question: what really defines a full-time equivalent? They have defined that as average hours per week divided by 40. So over the 8 weeks, you're going to figure out the average hours worked for your 8 weeks. If they did work 8 weeks, take that weekly average of hours and then divide by 40. 40 and above equals 1 full-time equivalent. So you can't get any more credit than 1.0. So it's 40 and above is 1.0. For any employees that are under 40, you have two options. You have a simplified method, which is simply anyone under 40 hours is going to equal 0.5, or you can choose a calculation method, which is simply going to divide your average hours into 40 and round to the nearest 0.1. So if you had someone that worked, 10 hours on average, which is going to divide out to 0.25, you would round that to 0.3. So you really need to look at both options. If you're having trouble with your FTE test, then you might want to look at both of those options. But that's what's been defined as a full-time equivalent. So the next rule that they kind of laid out that was pretty clear is on this excess 25%. This has been defined as strictly a wage reduction, either a salary or hourly wage reduction. So it's basically asking the question: did you drop someone's salary by more than 25%, or did you drop someone's wage, hourly wage by more than 25%? I think for a lot of you, this probably wasn't the approach you took as much as do we lay people off or keep people. So there was a lot of debate on how this was going to be measured as far as total wages, and was working less hours going to impact this calculation. And I think they cleared that up by saying, no, this isn't a Q1 wage versus Q2 wage. It's simply a rate, or a salary or an hourly rate analysis to see. So if you drop someone's hourly wage from $30 down to 15, you're allowed to drop it 25. So again, any rate reduction beyond 25, you would take that, multiply it by the average working hours over the 8 weeks, and then times by 8, and then that would get your 25% excess. But again, I think this is going to be pretty minimal, because I don't think a lot of people took their wages, hourly rates down greater than 25% in general. But if you did, they've defined the calculation. The last area I kind of want to walk through is this full-time equivalent test, because this is really the one that has the biggest impact on your potential forgiveness. The original bill outlined that you have two coverage periods, prior periods, that you're going to compare your headcount to against your coverage period. So you could choose February 15, 2019 through June 30th, 2019, or January 1st, 2020 through February 29th, 2020. So whichever of those two periods was less, you could use as your baseline. And then you're going to compare that to your 8 weeks of your coverage period. And if you had any reduction in full-time equivalent count, there would be a straight reduction to your forgiveness. So let's say you had $1 million PPP loan, and you had 300 employees that was the lowest number of either of those two prior periods. But you were fairly significantly impacted, and so when you got your loan, you were only working 150 employees, and you kept that 150 employees the same all the way through your 8-week coverage period, and you really only spent half or so on your loan forgiveness. So let's say between your payroll and your non-payroll, you spent $600,000 of that $1 million. But unfortunately, since your headcount went from 300 to 150, that calculation would say that you would have the 50% reduction. So of your $600,000 spent, only $300,000 would be forgiven, which means that other $300,000 you spent would be a loan, and then the remaining 400,000, it would just depend on if you wanted to keep it as a loan or pay it back. But it's really a significant penalty because you've already spent that other 300,000. So they're offering two ways to cure this full-time equivalent test. One is through just a straight safe harbor. And the safe harbor, there's two steps to it, which is in this section. Step one, the borrower reduced headcount in between the period February 15th through April 26th. So if you laid any people off during that time period, you can answer that yes. And then the second step is that by June 30th, if you returned your headcount to where it was on February 15th, then you could ignore that first calculation and you can simply meet the testing requirement through this safe harbor process. And so then you would have no reduction. So what they did is this rehire language that was in the bill, they've kind of put this in this standalone safe harbor calculation. So again, you're going to look at your headcount on the week of February 15th. You have to have gone down from February 15th to April 26th. That's the first requirement. And then the second is that you have restored your full-time count to that February 15th level by June 30th. So that's probably the most straightforward way to get that this test totally eliminated. The other thing they did is they added a full-time equivalent reduction exception. So if you laid someone off and then you tried to rehire them and they refused to come back to work, and you can document that at some level, then you could add that back to the first test because you can add it back to your coverage period count. And then the other is if someone was fired for just cause or they voluntarily resigned. So those are some exception areas where you can help your calculation on the full-time equivalent under those three scenarios. So they kind of laid out some ways to make it easier to satisfy the full-time equivalent test through those two steps. And I think, and then the last piece of the information was an optional, just an optional census, or I'm trying to think of a term they used, optional demographic information that they're going to ask at the end. So that's it. That's the 11-page application that was released last Friday. Just kind of trying to highlight and talk about some of the key pieces that they have released and that we've got guidance on. I mean, we'll go back to the presentation now. And so I think the question is what didn't they define? And I think there's still some gray areas in some of the non-payroll costs. They have clarified that rent and leases can include both real and personal property. So again, if you have operating leases for equipment or copiers or vehicles that are company assets that are on an operating lease, those full leases can be included with the rents. If you have, equipment finance, the same thing applies to mortgage, the interest component of mortgages and personal property loans. And I would include capital leases in that. If you've got dollar buyout, again, those are things that the interest components of those equipment leases are, that can be included, equipment loans or equipment leases. So those things can be included as well. But there still is some question, if you had a month of rent deferred and you wanted to include 3 months in the coverage period, there's still some definitional, guidance I think that we're looking for, because in the non-payroll it talked about paid or incurred versus paid and incurred. So I think there's still some question marks of some of these non-payroll costs and really what's a reasonable amount we can put into that 8-week period. Obviously, the most conservative approach is, 56 days worth, but there does seem to be some potential flexibility to that I think some additional guidance will be coming out in the next couple of weeks to kind of clarify those things. So I know I'm getting pretty tight on time, so I'm gonna go quickly through just a little bit of cash flow management. You know, it's really important that as you work through your forgiveness calculation and you understand maybe how much is forgiveness and how much is loan. I think part of the equation is you really have to look at what your business needs from a cash flow perspective. And so I think it's important that, you know, you have a 13-week cash flow type model, and you're really seeing where is your cash going to be at the end of your coverage period. And a 13-week cash flow model really gives you visibility. You know, you can really build that out to 13 to 20 weeks and really just kind of use more of a planning process. Again, a 13-week cash flow it's not like a traditional statement of cash flow, which is just a measurement of balance sheet change. You know, this is more cash checkbook driven. It's more dynamic. It's customized to your business. You know, and it's something that a lot of banks ask for. You know, so if you haven't been asked by your bank, you know, you may be, because these are uncertain times, and you know, banks kind of want to know what your plan is and how strong is your liquidity. So a 13-week cash flow takes what we know in our agings on the receivable and payable side, and it forces us to plan kind of what do we think our sales pipeline is, where do we think our future expenditures are going to be, especially if we have large inventory buys that we need to plan for. And this is a living document that we just maintain on this rolling basis, but it's really a tool that allows you to involve not only your finance team, obviously, who's going to facilitate this, but other people in your organization, your sales folks, your production planning folks, your purchasing folks, and really get everyone working together to map out really what are our cash needs over the next 13 weeks, and in particularly how is PPP helping our cash flow, where are we going to be at the end of the period, because it might give you some insight on some of your decision making. You know, do I need to bring everyone back? If I've got people on unemployment that are doing pretty well on unemployment, am I better to save more cash from PPP, understanding maybe not as much will be forgiven, but maybe that's what your business needs. Maybe you don't have access to other lines of credits or capital that, you know, you're really concerned about July, August, and September. So maybe maximizing cash flows is maybe more important than getting every last dollar on the forgiveness side. So a tool like this can really help you work through those issues and really understand where your cash position is going to be coming out of your 8-week coverage period with your PPP loan. So, and I think that is it from my standpoint. And now we're going to turn this over to Tony, and he's going to he's going to walk through some of the tax.
All right, thank you, Tom. So with all of the changes and the new legislation that's come out, there has been plenty of tax opportunities to both utilize and take advantage of related to COVID-19 legislation. And for this presentation, we're actually just going to focus on a few of those that we've actually received the most questions and the most interest from our manufacturing client base. And that is going to be the employee retention credit, which almost acts like an alternative to the payroll protection loans, and we'll talk why that's the case. We'll then talk about the actual tax consequences of taking out a payroll protection loan itself. And if we have time, we'll wrap up with some tax savings for our manufacturers related to their actual plants and facilities. So moving on to the actual retention credit. Again, this sort of acts like an alternative to your payroll protection loan because you can't utilize, at least currently as written, you cannot utilize both of those provisions. So what actually is a retention credit? It is a refundable payroll tax credit, so it's payroll tax, not income tax, that is equal to up to 50% of qualified wages paid by an eligible employer. And this applies to wages after or paid after March 12th through the end of December of this year. So it is, at least for now, a temporary credit because it does expire at the end of 2020. So now let's actually define a couple of those terms. So what makes you an eligible employer? And for this test, you have to meet, it's actually a two-part test that you have to meet. So number one, you have to be carrying on a trade or business in 2020. And we don't have to dig too deeply into this because, you know, presumably if you're on this webinar and you do have, you know, and you're paying payroll, basically you're paying wages, well, you're definitely going to meet that standard of a trade or business. So the other thing is you need to have operations that were either impacted by a government order, or, and this is the government order test, or you have to have a greater than 50% reduction in quarterly sales, and that's going to be measured on a year-over-year basis, and that's known as the reduced gross receipts test. So let's actually dig a little deeper into each of those tests. So for number one, for that government order test, again, you have to have operations that were impacted, and that can mean either fully or partially or even possibly indirectly. So let's talk about a couple examples here. So number one, let's say we have a manufacturing plant in business that is not deemed essential and has been fully shut down. Well, obviously in that case, you have had operations impacted by a government order because your plant is not up and running. But let's say on the other side, our manufacturing facility and business is deemed essential by the state or the local jurisdiction. Well, as long as that company is omitted from any of the restrictions placed on it by a government order, you would not qualify under the government order test. But what happens, because we've seen this, what happens in the case that we have a government order that causes one of our key suppliers to shut down, even though we are considered an essential business? And if we look at an example, this is an example we actually came across. We have an auto parts manufacturer that is considered essential, but our key supplier of raw materials is required to shut down in a different state, is required to actually shut down because they weren't deemed essential, and we have no other way to obtain those raw materials. Well, in that case, our operations are clearly impacted. We can't run our plant. So we would qualify under this government order test, even though we were deemed essential by the state. So you would need to consider really the facts and circumstances of your specific situation in most instances if you were deemed essential. But even if you couldn't meet that government order test, you could still be able to meet that reduced gross receipts test. And for this, it's just simply looking at your gross receipts compared on a quarter-over-quarter or a year-over-year basis on that quarter to qualify. And what you need is a 50% reduction. So I'm looking at comparing Q2 of 2020 to Q2 of 2019. If I see a 50% reduction, I then begin to qualify under this test. And you actually stay qualified and you remain eligible through the end of the calendar quarter in which your gross receipts are restored above 80% from that prior year quarter. So again, the government order test, all you have to do is meet one of those the government order and the reduced gross receipts test, all you have to do is meet one of these to be considered an eligible employer for the retention credit. So that is the eligible employers, but what actual wages are going to qualify? And that's really going to depend on the number of employees you have, because there's two standards here. So if you have 100 or fewer employees, it's going to be very simple. All your wages paid to employees are going to qualify. Now, if you had more than 100 employees, only wages paid to employees who are either furloughed or face some type of reduction in hours, and this is key, and they're still compensated for it, are going to qualify. So let's actually jump down to an example on the next slide. And in this case, we have a manufacturer who is basically, they have over 100 employees. So they fall under that rule, basically that says that you have to only include wages that are included for employees that who are basically not providing services in that case. So in our example here, we have 100 full-time employees in 2019, or greater than 100 full-time employees. And for our hourly plant employees, in this example, our plant is being shut down due to a government order. They're not providing any services, clearly, because they're not going into the plant. And they're being compensated 50% of their normally hourly wage. We also have a headquarters admin staff who are basically working at a 40% capacity. I'm sorry, they're working at a 60% capacity, but they're being paid for 100% of their normally hourly wages. So essentially 40% of their time is for not providing services. So in this case, what wages are going to qualify? Well, for our plant employees who are not working, all of the wages paid for them are going to qualify since no services are actually being provided by them. But for our admin staff, only 40% of wages paid are going to qualify, since the other 60% they are presumably providing services for. So the one thing to note here, again, this is an example with over 100 employees. If we were under that 100 employee count, or 100 or fewer, the test would be very simple. All wages would qualify. So our analysis would be completely different under that scenario. So the one thing I want to point out too is that, because this has gone back and forth, qualified health plan expenses are included in eligible wages, and you can allocate these expenses to employees basically using any reasonable method. And one common scenario that we've seen with some manufacturers here are they have been shut down, so they have furloughed their entire staff for the most part, at least the people inside the plant. So they're not actually receiving any wages. So the one issue that's come up is the IRS actually released guidance about 2.5 weeks ago saying, well, you can't include those health plan expenses if you're not paying any wages. Since then, they have changed that position to actually comply with the actual intent of the statute, and now have said, okay, you can include if you are providing health plan or health. Basically, if you're providing health benefits for employees, even though you're not paying them wages, well, you can still factor that into the retention credit. So sticking with payroll taxes, we're going to actually look at the FICA tax deferral for employers. This is a completely separate provision, first of all. And this allows employers to defer paying the employer portion of certain payroll taxes through the end of 2020. And that is going to be that 6.2% share of FICA taxes. And again, it's only the employer share of this. And again, this is only a deferral, so you do have to repay this amount. And 50% is going to come due at the end of 2021, and the remaining 50% is going to be due at the end of 2022. So now let's move on to the next slide that gets into, we're going to shift gears a little bit and talk about the actual implications of taking out a payroll protection loan, because all these provisions don't necessarily work together. And number one, if you do obtain that payroll protection loan, you cannot, at least for now, you cannot also claim the employee retention credit. So you have to choose, or you did have to choose, between one or the other. And in most cases, because of the amount of the payroll protection loan, and more specifically because of forgiveness associated with that, the payroll protection loan was a better option, but not always, that wasn't always the case. The second item on there, employers also cannot defer paying the payroll taxes that we just discussed if they obtain a PPP loan. And also key here is they also have a portion of that loan forgiven. So unlike the retention credit, you can utilize this provision, meaning you can defer payroll taxes up until the date the lender actually issues a decision to forgive that loan. So you can defer up until that time. Now, what are the tax consequences of the actual loan forgiveness piece? So how is that going to impact us in our business on the tax side? And generally, the rule is when debt is forgiven, you have to pick up that debt forgiveness as income on your tax return. But with the payroll protection loans, what the Congress did in the actual statute itself, they wrote in there that payroll protection loan forgiveness will not be taxable. So that item we do know for sure. Now, what about the expenses that are forgiven? Are those going to be deductible on our tax return? So, for example, are we going to be able to deduct, let's say, our wage expenses that are really, in this case, funded for by the loan forgiveness? So are we going to actually get both the cash benefit in the form of the loan proceeds, as well as a tax benefit from the deduction? And we initially didn't know for sure what the answer was going to be, but and really we still don't know for sure, but the IRS did end up releasing a notice to address this, at least for now. And in this, they say, basically, they took the position that no deduction is going to be allowed for the payment of any expenses that result in forgiveness. So, for example, your payroll costs that make up the 75% of the loan forgiveness calculation, well, you're not also going to be able to deduct that as, let's say, a salary or a wage expense on your tax return. And again, I put on that slide, this could change because Congress has already stated their intent was to allow these deductions for tax purposes. And they plan on fixing this in the future, at least with the next legislation package. So I do think in the end, we could use, or we could see these expenses being deductible on a tax return. But for now, according to the Treasury and the IRS, who obviously enforce these items, they are not. So I want to leave some time for Q&A. So we're going to actually skip over the next session, and I'm going to turn it back over to Melissa, who's going to moderate the Q&A portion.
So we have quite a few questions that have come through our Q&A or via email over the course of the last hour. We're going to do our best to answer these at a high level. And then those questions that maybe we don't have time to or are a little more specific, we will make sure that we get those answers out to you, whether it's directly because we have the attendees' names or in a out to the participants. There were a lot of questions regarding how do we calculate loan forgiveness for payroll periods that are either some biweekly, some are monthly, there's alternative pay arrangements. Tom, I was hoping maybe you could kind of discuss with the group, how would they go about that calculation if there's some alternative pay arrangements?
Sure. So if there's a lot of clients that have maybe their hourly team on weekly and their salary on biweekly. So I think it's gonna get down to the tables and how you calculate. So you're still gonna track them, the same way on the tables. It's just, I think where you're going to run into some challenges is that you're going to have a consistent either coverage or alternative coverage choice made for your payroll. So if you have something more than a biweekly, you're not going to have the option for the alternative payroll. So you're going to have to run under the coverage period. At least that's the current guidance. Because you've got to be consistent with payroll as a whole with one of those two methods. So, to mix methods on the same schedules just isn't going to work with how they're laid out currently. So the first step is to pick the method, and then on the tables you could subgroup. Put all of your just for your administrative side, put your hourly people at the top of the table and your bi-weeklies below, but you're going to have to pick a method that fits overall for your company.
Tom, another question has come through. Are full-time employees from a staffing company included in the full-time equivalent calculation, or would those employees need to be excluded?
Yeah, I think that's one that we're waiting on some additional guidance to define how, but they were included, on the application process. There was guidance that said, PEOs and payroll providers in similar companies, which we interpreted as temporary agency companies, those companies that were giving you 40 hours of worth of work are mostly full-time people. I think the first step you need to do is to reach out to your agencies and say, I'm working on my forgiveness calculation, but I want to confirm, because the guidance in the loan application was that those employees couldn't be double counted. So the employers, were including them. That meant the temp agencies could not. So I think you want to reach out to your temp agencies and say, hey, we've got all these full-time employees. We're planning on putting them in our loan forgiveness calculation. Could you give me something in writing just confirming that you understand that you're not including them if you did get if you did your own loan application? Because a lot of agencies might have had some people that weren't dedicated and they farmed out to many different clients, and they might have applied for a PPP for those type of individuals. So I think it's important you reach out to your agency and just get on the same page as quickly as you can.
Another great question has come in. Obviously, there was not a lot of clarity around these loans when the initial application process began, as Ron kind of indicated with all the facts and questions that followed. Now that there is a definition of a full-time equivalent, do companies need to go back and recalculate full-time equivalents differently during the look-back period if it is different than how they calculated at the time the loan application was completed?
So the application and forgiveness are two different processes. For the application, you were certifying that you were, under that 500 employee level, and they have said that if you submitted your application under the guidance that was in place at that time, you're all set. You don't need to go back and change anything. So I don't believe there's anything that you'll need to do related to the application now that they've given this definition. Now, if you did, now this is for the forgiveness calculation. So if you did do some prior period calculations, you might need to relook at how you've done that. But you just want to be sure that you're using this definition for calculating your two prior period options and your coverage period. All three of those should be calculated using this new updated guidance.
Tony, there's a question on, with all the updated tax credits and provisions out there, how do you recommend keeping track of those expenses that will be on your financial statements that will not be able to be used for expenses on the tax return? Do you have some recommendations for the group on how to track that?
Yeah, so really it's going to depend on what basis you're presenting your financial statements on. So for non-deductible expenses, and let's say we're talking about a tax provision, all these expenses, let's say related to payroll protection loans and forgiveness that potentially aren't going to be deductible, are going to be a permanent difference on your financial statement. So if you're presenting on GAAP basis, this would just be a reconciling item to your actual tax return.
I think we have time for one more question. This is a question that's coming. Forgiven, how do you clear that amount of your balance sheet? Is this going to be an increase in capital?
Sorry, Ashley, you broke up in the middle of that question.
Sorry, I'm having internet issues. The question is, when your loan is forgiven, how are you to clear that off your balance sheet? Are you increasing capital? Is it loan forgiveness? That's other income?
I mean,
Yeah,
I think go ahead.
I was going to say, from a tax, if we're talking about a tax basis on your balance sheet, from, as our understanding of it is now, is you would have, potentially an increase in basically tax exempt income, and then a decrease from non-deductible expenses. You would net to the same amount. This is from a tax basis standpoint.
And from an accounting standpoint, you know, it's going to be a debit, you know, to that loan balance that was originally set up, and it's going to credit. You know, we'll have to get some GAAP guidance, but just from a from the bookkeeping standpoint, it's probably going to be a credit to you know, a debt forgiveness, probably in the 9,000 other income area, just so we can keep our comparatives and our historical operating income numbers in line. So I would think most people are going to want to credit that other income as a forgiveness pickup to income.
Yeah, Tom, on the GAAP side, that is where the guidance is currently falling. We will continue to update that. That is not completely clear yet. So we will send those. That does wrap up our current webinar for the day. Like I said before, we will make sure these questions get answered to you either directly or in a group Q&A as part of this webinar. We really appreciate all of the time that you took to join us today. The slides and the recordings will be sent out so that you can use them at your disposal. Again, continue to reach out to any one of us or to Christy if you have questions or concerns that you need help with. And also, we do have part 3 of this webinar series, a discussion around and concerns that the pandemic has kind of maybe not brought to light, but highlighted over the last couple of months. So with that, I hope you guys all have a great day, and we look forward to talking to you soon.